Yesterday, we talked about possible distortions in the market and how that's going to affect mortgage rates. So, the GDP numbers are a really good example of how you can get a holiday distortion. Holidays are typically a slower time of year, and so trading also slows down. With lower volume and thinner liquidity, the markets can shift a little bit more. It's a distortion from even just little things. GDP came in much stronger than expected, and bonds sold off fairly sharply in response. It's a really good example of what we're talking about. At first glance, it may seem like a really meaningful shift, but when you look under the hood, the move doesn't line up with regular market behavior. Here's the key tell. The price movement in bonds is unusually large, but the trading volume is very light. In fact, the volume behind today's sell off isn't even half of what we would typically see after major reports like the jobs report or inflation, yet the price reaction is bigger. This mismatch is classic holiday distortion. With fewer participants, it takes much less trading to push prices around. In other words, today's move looks louder and more dramatic than it really is. Why this matters for mortgage rates. As you know, mortgage rates follow the bond market, but not every bond carries the same weight. Moves that are driven during this holiday time with such thin trading are likely to dissipate very quickly when we have more normal trading volume. While today's GDP driven sell off may cause short term upward pressure on rates, it doesn't necessarily signal a new trend or a fundamental change in the outlook. Bigger, more durable rate moves usually require strong data and broad market participation. Right now, we only have one of those. The bottom line, today's weakness is more about the calendar than the economy. I hope this information helps. If it does, give me a like and a follow, and I hope you have a great day.